Central Bank of Nigeria says the non-performing loan ratio in the banking sector fell to 6.4% as at the end of June this year. That's from 9.4% in the same period of the year 2019. CBN Governor Godwin Emefiele disclosed this while speaking on the state of the banking sector at the 131st Monetary Policy Meeting. Joshua Odebisi, a senior banking analyst at Vetiva, now joins me from Lagos for a focus on Nigeria's banking space. Joshua, a pleasure to have you join us for this conversation on Closing Bell West Africa. Now, we've had a number of projections come from the development and finance institutions across the globe between the CBN's last MPC meeting and the one that Nigeria had yesterday, sparking uncertainty about what the decision of the Monetary Policy Committee would be. Did you see them holding rates like they did yesterday?
Yes, I think it was expected that the CBN was going to hold rates simply because our situation is not quite like the same as all the other economies that were, slashing rates here and there, because our economy is more reliant on, natural resources, i.e. oil, and the price of oil is depressed, and our foreign exchange income is pretty significantly damaged. So overall, I think it was quite expected that they would hold rates, although some were expecting maybe they would, release or reduce the pressure on banks by maybe, giving them leeway with the CRR, but that was a little bit too optimistic, I think.
So in the last 24 hours, if it's not too early to start gauging sentiments within that sector, how would you reckon the banks have responded to the MPC's decision?
Well, first of all, we have to understand that the banks are in a little bit of a tight spot because, obviously CRR has remained pretty high, even though it's, officially set at a certain level. The CBN has been pretty routinely deducting from the banks and keeping liquidity tight in order to manage, FX demand. Now, at the same time, inflation has been going up, and the main purpose of all these monetary policy rates is to control inflation. Now, the reason why this is not also a surprise is because, the real policy shift has been with foreign exchange. We've seen our FX go from 306 to 360 to whether or not it's official 380. So that is the main driver of inflation right now. And so the banks would have to, continue to adjust for that. But I mean, the positivity around the MPL has to be put into context. The truth is that at the end of last year, MPLs were at about 6.0%. So they've actually worsened slightly to 6.4%. But that was to be expected, obviously, after the onset of COVID-19. But there is cause to be optimistic because almost half of all the total loans given out by the banks have been approved to be restructured, about 41%, I believe. And overall, this means that we're going to see, less strain on non-performing loans by the end of the year, even though there will be significant impact on interest income.
Now, in the immediate term, in what ways do you expect the Nigerian equities market to respond to the MPC's decision?
Well, in the medium term, it's hard to say because there are a lot of exigent factors that would still impact, investor sentiment, i.e. the price of oil, and of course, half-year company performances, which we'll start to see. Now, it will be very interesting to take note of what the banks especially are going to do. The expectation amongst, analysts, the consensus is that there will be a significant, they will still declare interim dividends in order to keep investors happy. But the problem is that so far, foreign investors' interest has been pretty poor, as we have seen. The banking sector is down about 24% year to date. However, I think some savvy investors and the local investors are still very much interested in, some of the stronger names like your Guarantee and your Zenith and what have you. So I think that's what is going to drive interest and, investment from the local space in the near term.
Now, talking about what's driving investment, and also on the other hand, as the CBN continues to struggle to take a position on rates, balance inflation, which is hurting interest rates, the key question that investors will be asking analysts like yourself is, what alternatives are there for hedging their investments? What are you saying to them?
Well, okay, in terms of hedging your investments, obviously foreign currency is a pretty good idea. However, due to the lack of liquidity, that might be a bit difficult for some investors to partake in. However, there are other options such as your natural resources, your gold, most especially. I think gold right now has been on a pretty significant rise. It's approaching the $2,000 mark. So I think that is somewhere that investors should look. So your natural resources, then you have your alternative investment avenues. We won't go into all your cryptocurrencies. They might be a little bit murky, and investors are not yet fully familiar with them. But I think there are definitely opportunities out there for investors who are still willing to take their money and invest for the long term. And the equity market is still a strong pull if you are a long-term investor, because the fact is that this economic downturn is likely to be maybe U-shaped, and so the stocks are likely to be depressed for a more extended period of time, giving you opportunities to spread out your investment and wait for the long term, for when the economy is back on track and stocks pick up again. So there's no reason why investors shouldn't continue to dip their toes into the equities space and pick on the fundamentally sound stocks.